Welcome to this episode of the In Focus Educational Series. I'm Candis Fitch, Portfolio Manager at IAIC. Through these educational episodes, we aim to help you have a better understanding of various topics and terminology. At IAIC, we follow 7 investment principles. In a series of podcasts, I'm going to do a deep dive into each one. In today's episode, I'm going to cover quality investing. Let's dive in. Our equity selection strategy is best described as quality investing, but what does this mean? Well, it means we're looking for companies' quality to be the reason we choose it. Quality is defined for us as companies who are dominant industry players. This means we're getting the top companies in that industry. So this means a company who might be in the middle of the pack or one of, 1,000 out of hundreds of thousands of companies that do the same thing. That is not a dominant industry player and not what we're looking for. Quality is also defined to us as having strong barriers to competition and to entry. So a great example of this is Canadian banks. They are well established, and any newcomer would have some stiff competition trying to take market share away from them. They also have a strong barrier to entry in that sector. Not any average Joe off the street can decide one day they want to open up a bank. Also, having a proven, profitable business model and predictable earnings. So the newest company in the newest industry with unpredictable earnings is not what would make it past our quality filters. We are focused on buying companies with a proven track record. Predictable earnings, for the most part, assists in our valuation-based approach, and it's a big indicator of the quality of that company. If their business model is not proven to be profitable and their earnings are unpredictable, it doesn't meet our quality standards. Now, we also like to see track records of growing profits. Not only does a company need to turn a profit, but we also want to see them have a track record of growing that profit over time. This is important in business quality and their ability to stick around. We also like to see strong balance sheets. Our research team digs deep when it comes to combing through financial statements of companies. A strong balance sheet is an important quality factor to ensure the company meets our standards. And we also like to see high returns on equity. Now, this one may seem like a given. Of course, we want the company to have high returns, but a high return on equity shows us whether the company is effectively generating profits from their existing assets. Higher efficiencies, better quality. Typically, we like to see a company pay dividends and high probability to grow those dividends over time. Now, this can sometimes be an overlooked factor. A company paying a dividend signals to shareholders and the rest of the market that they had enough money on top of expenses to pay out money to their owners, aka shareholders. The ability of a company to continue to do this over time shows us that they are profitable. To grow that dividend over time and the high probability of growing it into the future is a good indicator of financial health of that company. We also like to see a reasonable share price based on current and predicted future financials. Now, this links back to the valuation-based approach that we use. When we have relatively predictable future financials, we can better value a company to come up with a reasonable share price. Better quality earnings lead to better quality valuations and results in better quality stock choices. Now, this is a good time to remind everyone that we are investors, not traders. We hold these quality positions for the long term. If you have any questions on today's topic, please feel free to reach out to me or contact your portfolio manager.